The concept of interest has a deep-rooted history intertwined with the evolution of trade, wealth preservation, and financial practices. As human societies progressed from simple barter systems to more complex economic structures, the need for lending and borrowing became evident. This necessity laid the foundation for the emergence of interest. Initially, exchange systems were purely transactional, involving the direct trade of goods and services. However, as societies became more advanced, people and institutions began to act like early forms of banks, facilitating trade and providing safekeeping for valuable assets. This gradual shift from barter to trade paved the way for lending practices. Interestingly, the first loans were often made without the expectation of monetary compensation but rather in exchange for goods, services, or a share of future wealth. This informal lending system marked the early stages of what would eventually become the practice of charging interest. The earliest form of interest was not financial but rather a form of compensation for risk, effort, or the opportunity cost associated with lending goods or assets. In ancient societies, wealth was measured in tangible assets such as livestock, grain, or precious metals. Lending livestock, for example, was inherently risky due to disease, theft, or death. Therefore, lenders expected compensation in the form of additional livestock upon repayment. This compensation was the precursor to interest. As the concept of preserving wealth evolved, lending practices became more structured. People began to lend money or goods without immediate returns, expecting to receive some surplus in the future. This surplus was not considered interest in the modern sense but rather a reward for patience and trust. Over time, this expectation became more formalized, leading to the development of interest as a contractual obligation. Temples and religious institutions played a significant role in the formalization of interest. Farmers and traders often entrusted their goods to temples for safekeeping, seeking protection from thieves, natural disasters, and rulers. In return for safeguarding these goods, temples would lend them out and charge interest on the commodities. These religious institutions effectively became the first banking institutions, with priests acting as bankers and initial interest earners. In the Sumerian period, which spanned from 4000 to 2350 BC, the practice of charging interest was well established. The interest rate was set at 33% for barley and 20% for silver. These rates reflected the risks associated with lending and the value of the commodities being lent. The Sumerians also introduced early forms of record-keeping, documenting loans, repayments, and interest rates on clay tablets. This system allowed lenders and borrowers to formalize agreements and track obligations. Over time, interest became a central aspect of economic interactions, facilitating trade, investment, and wealth accumulation. The practice spread throughout ancient civilizations, including Babylon, Egypt, Greece, and Rome. Each civilization adapted the concept of interest to suit its economic needs and cultural values. For instance, ancient Rome viewed interest with suspicion, and laws were enacted to limit or prohibit excessive rates. Conversely, Babylonian and Egyptian societies embraced interest as a legitimate business practice. The development of interest was not without controversy. Religious and philosophical debates arose regarding the morality of charging interest. In some societies, usury, charging excessive interest, was condemned. For example, early Christian teachings, based on biblical scriptures, prohibited charging interest to fellow Christians. Similarly, Islamic finance, guided by Sharia law, prohibits interest, riba, to this day, promoting profit sharing and risk sharing instead. Despite the controversies, interest became a cornerstone of modern finance. It incentivized lending, facilitated investment, and enabled economic growth. The evolution of interest reflects the progression of human society, from simple trade to sophisticated financial systems. Today, interest rates are integral to global economies, influencing everything from personal loans and mortgages to international investments and monetary policy. Understanding the origins of interest provides insight into the development of financial systems and the importance of risk, time, and value in economic interactions. What began as a way to compensate for risk and opportunity cost has become a fundamental element of modern economies, shaping how wealth is created, preserved, and transferred across generations. The strange issue is that in the end the religious who were opposed to interest found an optimization ways or abandoned that faith rule in practice. The Islamic systems has designed participation share system and validated its legality. The main argument is the exchange of goods, not only money. The Christian Authority doesn't care so much about this rule. The biggest money owners of the modern world are Christian countries or business allies. Who started the rule and who left it?